Hello and welcome to today's Market Matters video update for Thursday, April the 6th. I'm Harry Watt, joined by James Gerrish. Firstly, last week was the end of the March month for markets. James, let's go to run through of what happened in markets. Where did equity markets go? What happened in bond markets? What happened in commodity markets? Just a broad picture for our subscribers, James.
Yeah, a lot happened in March, and it was a pretty, it was a choppy month overall. By the close, the S&P ASX 200 fell 0.16%, but that probably overshadows a fair amount of volatility. Obviously, it was headlined by the regional banking crisis over in the US. A number of banks failed over there. We, of course, had the forced takeover of Credit Suisse by UBS. If we rewind to January of this year, it was a really bullish month, but then we had a weak February and then a more tepid March. So all in all, for the quarter, the market was up around 4% here in Australia, but March was fairly volatile for all of those things. But I think the main takeaway, if we're thinking to hang our hats on one thing in March, was interest rates. So interest rates to us have peaked, and that has really broad ramifications for equity markets, and particularly the underlying sectors and stocks that you want to be exposed to, as well as broader financial markets. So I think the other key takeaway I'd say in March is that we got an indication that central banks are going to do what they can to backstop the financial system. We saw them make some pretty swift and important moves over in the US to backstop that banking system over there. So I think that's an important consideration if you're thinking about whether that was going to be something more meaningful for markets or not, or long-standing for markets, if you like, Harry. So a reasonable month to kick off the end of the quarter.
All right, James, given that backdrop, we obviously run a multitude of portfolios at Market Matters. Given the backdrop of markets in March, how did our portfolios go performance-wise?
Yeah, so we had a pretty good month of performance. So, and it's coming off a reasonable quarter of performance. I'll just get my performance numbers that I didn't have ready beforehand. But the flagship growth portfolio did 2.15% for the month. So you think about, it's a large cap Aussie equities portfolio, benchmarked against the ASX 200 accumulation, which fell 0.16%. So putting on 2.15% was really pleasing. Financial year to date, that portfolio is up around 20 odd percent, 22%, and it's put on more than 20% over the per annum over the last 3 years. So really happy with how that portfolio is performing. We've gone consistent outperformance over a long period of time. So really pleased on that portfolio. The income portfolio, a more sort of defensive set portfolio, combination of equities and fixed income securities, that did 0.64% for the month. That benchmarked against cash plus 4%, so that was up 0.58%. So again, ahead of the benchmark. Emerging companies were down 2.29%. Its benchmark is was down 0.72%. Financial year to date, it's up 9.85%. It's done about 12 or nearly 13% for the past 3 years. I've got to say, small caps have been a really more challenging time, as you'd know, Harry. If I look at the quarter, small caps were only up very marginally, about half of that of the large cap indices. So the continuance of challenges in the emerging company space remains. And then finally, our international portfolio put on 4.86% for the month. The benchmark was about 3.7%. It's done 18.5%. Financial year 23 to date, and it's about nearly 17% per annum over the past 3 years. So I'll wrap that up, Harry. Happy with how it's going collectively. So onwards and upwards from here.
Moving on to asset allocation for the back end of this financial year, James. Obviously, the main mover has been the RBA pausing on rate hikes recently, just the start of this week. James, how does that play into our asset allocation moving forward?
Look, it gets written up a lot around what the RBA is doing, but we're more focused on what bond yields are doing and how financial markets are pricing the outlook for interest rates and what our view is around the outlook for interest rates. So, we thought they would pause, or we think they should have paused. You've had 10 meetings where they've hiked interest rates from 0.1% emergency settings up to 3.6%. It makes sense to take stock and see where the impact of these interest rate hikes are having. Of course, we've got nearly 900,000 mortgages coming off fixed rate this year. So, a lot of the media call that a mortgage cliff. We've written that. The RBA governor says it's more of a slow mountain to climb, if you like. He said that yesterday. So, look, I sit back here and think about what the dynamics around interest rates have on asset allocation at the moment. Clearly, you should have been in floating rate bonds, etc., when interest rates are at emergency levels. Now we're about average, so you probably move towards more of an average positioning. So if you think about hybrids as floating rate fixed income securities, then you should be, in our view, we're keen to move more towards fixed rate bonds at this point in time, or balance our portfolio up accordingly to that. In the equity space, so obviously different sectors have different influences from interest rates. I think the key takeout, and we've written about this recently, is around gold and commodities more generally. The US dollar, we think, continues to go lower. There's going to be a bigger interest rate differential between the US and other countries playing out, in our view, over the coming 12 months. That puts downward pressure on the US dollar. So gold has broken out through 2,000 US an ounce. We think that's got more to go. We're generally bullish on the commodity side, but we've actually been more long technology in our portfolio. So gold, we're overweight. Technology, we're overweight. We're going to start moving towards a more neutral stance in technology and allocating some of the capital back into the value parts, the resources and the like. So we will, over the next couple of weeks to months, be more amending our portfolio. We've sort of had the same set for the last few months, at least 6 months or so, but expect some more moves across our portfolios in the coming months, Harry.
All right, just touching on commodities more generally, if we're going to move back into a bigger allocation in that area, what areas within that commodity complex, because it's very broad and lots of different levers within that, what areas would you be picking the eyes out here and now, James?
So if you break it up into, so we've got some copper exposure now. We've obviously got exposure to the large cap miner BHP, but we're underweight that space. We're not a huge, we're not super bullish on iron ore. We think there's interesting in the ESG side. So lithium has been absolutely belted. As it was a really crowded trade. We think we can start nibbling back into that area. We did so this month in our flagship growth portfolio, buying Mineral Resources, which has got some iron ore exposure, but the real kicker in its valuation is around the lithium space. So the energy area, so coal, we've been pretty vocal on. We like that at these levels. We think that goes higher. So Whitehaven, New Hope, and you've got Boeing, Coke and Coal in your emerging companies portfolio. So, and South 32 is one of those commodities, really stocks, really diversified commodity base, but without iron ore. We think iron ore is probably going to have a few challenges near term. And then you think about the oil price. OPEC came out and cut production. That was pretty meaningful. So we think oil prices go higher from here. So we've got Woodside in our flagship growth portfolio, but we'll probably look to build that out as well.
All right, there's a bit of a, what did I call the OPEC put on the energy prices from here. It's not just oil.
From the Fed.
It's the Fed put. It's no longer the Fed put. It's the OPEC put. That's all we've got time for now. I hope you enjoy your Easter break, and I hope you got something out of this video. But thanks for joining us today.